So, welcome back to the second half here. I'm Mike Petro, the Executive Vice President of CED, and I'm pleased to welcome our next set of experts to the stage here. America's corporations continue to face stiff pressure from activist investors seeking higher short-term returns, potentially at the expense of longer-term, enduring shareholder value. These shareholder activists are using bolder and more creative tactics. Now, our panelists will examine whether activists are undermining corporations' long-term strategies designed to benefit multiple stakeholders and investors with short-term horizons. I want to thank the conference board, especially Doug Choff, for working with us to develop this session. And of course, moderating the panel is Martha McGarry, and Martha is a friend of CED. She's been involved with us for several years and has spoken on our panels and supported the organization. And she's a partner at Skadden, Arps, Slate, Meagher, and Flom, and has 40 years of experience in both U.S. and international mergers and acquisitions, corporate governance policies, and shareholder activism-related issues. Martha also has experience working with firms in a broad range of industries, including consumer products, finance, telecommunications, technology, defense, gaming, real estate, and pharmaceuticals. So I want to thank again Martha and the panel for being here. And Martha, I'll let you introduce the panel and get the discussion started. Thank you.
Let me just set the table by noting a few of the more recent trends this year in the activism space. As Mike just said, the level of activity has remained extremely elevated the past year or two. And activists are increasingly targeting mega cap companies like Procter Gamble, GM, and ADP. They are targeting signed M&A deals like Huntsman Clarion. And they are trying to create M&A by targeting companies like Whole Foods, who within months of an activist coming in was sold to Amazon. Breakups are a very frequent theme once an activist appears. And a single activist has been responsible for two of them. Nelson Peltz came into DuPont, which in the coming year will split into 3 companies. And GE is in the process of doing the same thing after Peltz appeared. And just this week, Dan Loeb joined Bill Ackman in investing in United Technologies, which many people are now predicting could be the subject of a breakup in the future as a result of their aligned view on what should be done. Another development is with lower returns, many active investment funds, but non-activist funds, have nevertheless turned to activism, either by way of support or actually engaging in activism as a way to boost returns. Just a few of these funds who you may have previously thought of as your investment manager, Neuberger Berman, Franklin Templeton, Capital Research, T. Rowe Price, have all turned and supported activists this year. Neuberger recently requested leadership changes and ran a proxy fight for Nuance Communications, and Bill may or may not want to talk about that. And finally, but not the least, ESG, environmental, social, and governmental themes, have emerged not only as key themes to win support of governance teams of the big institutions, but they have separately provided themes for investment of specialty funds that some of these institutions are creating around these themes. So we have an outstanding panel today, and let me introduce them. Bill Anderson is Senior Managing Director at Evercore. He leads their activism defense business and strategic shareholder advisory practice. Prior to joining Evercore, he was a partner in the M&A group at Goldman Sachs, where he led their hostile takeover and activism defense practice worldwide. He is probably the banker who has been involved in activism defense the longest of any on Wall Street. Matt Mallow, Vice Chairman of BlackRock. Matt joined BlackRock in 2010, and from 2012 to 2016, he served as Chief Legal Officer. Prior to that, Matt was my longtime partner at the law firm of Skadden Arps. Currently at BlackRock, Matt works closely with the investment stewardship team and the governmental relations and public policy teams. Sarah Teslik, partner of Joele, one of the preeminent communications firms. She is the firm's leader on corporate governance. An interesting fact is that prior to joining Joele, Sarah, among other things, founded and served as the executive director of the Council of Institutional Investors for almost 20 years. Bill Ultan, managing director, corporate governance with Morrow Sodali. With 30 years of experience, Bill has represented clients in a wide range of governance and takeover challenges, including, previously, as a member of the firm's stock surveillance and proxy solicitation departments. So we're going to start the dialogue with Matt. And he does have a bird's eye view of pretty much everything that BlackRock does.
That's a bit of an overstatement.
Annually, Larry Fink, the CEO of BlackRock, has written a very, very closely watched letter to investors in January. And this letter frequently certainly establishes BlackRock's outlook on where they would like certain things that are important to them. And this year, he very pointedly asked companies to, quote, publicly articulate your company's strategic framework for long-term value creation. He then went on to say that a company's ability to manage environmental, social, and governance issues increasingly are becoming factors in BlackRock's investment process. So, Matt, we're going to ask you to decode this and tell us what is Larry getting at? We can hear the text. What's the subtext as well?
First, Martha, thank you for including me on this panel. Martha and I go back many more years than either of us want to count. I, in fact, go back longer because I remember when Martha first started out as a young lawyer and well before her distinguished career that she's had and continues to have. Let me put a little context around why Larry is writing what he's writing. So Larry has written 6 letters. I think this year was the 6th. The issue of publicly announcing a strategic framework made its first appearance at least in the 2017 letter, and maybe it was even before that. So it was really repeated today, this year's letter. Now, why is he even asking for those? So BlackRock, as an investment management firm, manages at year-end, December 17, and it's approximately the same today, $6.3 trillion of other people's money on their behalf. It's not our money, it's their money, and it's their asset allocation and choices. And of that $6.3 trillion, something over $4 trillion is invested in passive investments. Not all equity, many debt or fixed income instruments of some variety, but call it $2.5 or $3 trillion of equity. And that's all based on indices that third parties create, and we are required to seek to match that index as close as we can on behalf of the clients who purchase the product that's guided by that index. So we can't sell. To do that, how do we do that? For the most part, the way you do it is you buy all the shares in the index in the right proportions, and you rebalance from time to time as necessary. And rebalancing can be quite a big thing, but you rebalance and change the mix of the holdings to continue to reflect the index. So think about it, when a company goes out of the S&P 500, we have to sell that security. When another one comes in, we have to buy that security, etc. We can never sell those securities like an active manager. An active manager, if they're dissatisfied with a company's performance, actually votes with its feet. It just sells the security. It doesn't have to deal with the company going forward. But we as fiduciaries on behalf of our clients believe that we do have to deal with companies going forward. And as long as they're in the index, we're going to have to deal with them. So Larry's letters have really been trying to urge managements and directors of public companies to take a long-term view, because that's the view, frankly, that we have. 2/3 of the holders of BlackRock products are either retirees or people saving for retirement. So they have a long-term view, and we have to reflect that. So we're trying to encourage through these letters companies to take a long-term view and to announce it to the world through their public communication strategies, what that view is and how they're going to go about executing on it. Now, more recently, ESG issues, environmental, social, and governance issues, have come to the fore, and this year Larry mentioned them in his letter. But more importantly, what Larry mentioned in his letter, and the reason he did is we believe, although firmly embedded as capitalists, we intend to get a financial return for our clients. But we do believe that over the long term, companies that don't have a purpose, that can't articulate their purpose, that can't explain why they exist and don't follow their own internal vision, and companies that don't actually satisfy ESG standards will actually not perform as well financially. And there is some research that actually shows that to be the case, but over the long term, we believe it's going to become increasingly visible and prominent. So Martha, that's why Larry has put those things in his letter. And that's why Larry has publicly announced that BlackRock will increase the size of the group that we call the Investment Stewardship Group. That's the group that engages with companies. It meets with about 1,500 companies a year. It votes the shares we have control of over on behalf of our clients at about 17,000 meetings a year, most of which are not controversial. It deals with some of the people, Martha, you mentioned, some of the activists when they come after a company. We meet with a couple of hundred clients a year. If any of you are clients and want to meet with us to know what we're doing on your behalf, please call us. We'll be happy to meet with you. And so that group is going to double in size. And we are mathematically challenged because we have 31 people in that group today. And when we talk about doubling, we're going to make it 75. So for investment managers, we probably don't know basic multiplication. And we're going to do that over a period of 3 years. You can't do that all at once. You can't find enough people of professional caliber and quality to do it that quickly. So I hope that's a bit of an explanation, and I'm happy to defer to my colleagues now.
ESG, how do you square those laudatory goals with the pressure that a CEO feels to deliver short-term results in the face of an activist threat?
Well, activists come in many flavors. We don't actually believe there's one unique type of activist who is only a short-term person. There are plenty of activists who are, and we're not in favor of those. But there are activists who are long-term ones. You actually mentioned one who, Nelson Peltz, his average tenure on a board of directors is 7 years. That's not as short-term as some other activists who come earlier. He actually lost at DuPont. He didn't win at DuPont, as that you mentioned. He won at P&G. And so that is, so activists come in a lot of different flavors. It reminds me, frankly, of hedge funds. When I first started being a lawyer, a hedge fund was really a defined term. It was a private equity investment group that sold short in order to hedge. They didn't do fancy derivatives because they weren't around in those days. Now a hedge fund is any private investment vehicle, and they cover a whole waterfront. Yep. Well, activists do too. So we're not in favor of short-term ones, but we would be willing to listen to the longer-term ones as to whatever they're proposing, and we'll consider it.
Matt, has an activist ever come to BlackRock and say, we want to invest in plant and hire people?
Yeah, yes, but we've also not seen an activist who's come to BlackRock and said, because they don't say this when they come to us, we want to get out in about 90 days or 180 days or 2 years, because they know better than to say that to us. So we've never heard that either.
Go ahead, all of you. Yeah.
If I could just make an observation about what Matt just described and the really the irony almost when you compare it to the structure of an active manager. So active managers historically have had, a huge number of portfolio managers and analysts to evaluate companies. They make buy and sell decisions based on fundamental analysis. And here you have a passive investor that buys and sells based on index weightings and so forth, that is now investing in personnel to evaluate companies based on governance practices and disclosures that certainly overlaps to some degree with fundamental analysis and long-term strategies. But it's a very different paradigm than what existed just 5 to 10 years ago, certainly in terms of degree. BlackRock's been at this a long time, but the direction that this is going in is having a profound impact, both with regard to ongoing governance management as well as the more activist circumstances.
Yeah. So Bill Anderson, so I started this practice about 20 years ago. When all it was Nelson and Carl, who are still around. Now there's about 200 of them. And right now we're defending $1 trillion worth of companies in 31 situations. Companies like Nestle to Qualcomm, and every company. 25% of the S&P 500 has an activist or a major broker-dealer in their stock. So does Honeywell deserve activists? Does Amgen, these great companies? So this has become something that every company has an active shareholder to some extent. The index funds have been the long-term players. It's been incredibly helpful. Let me give you some anecdotes from the field. I remember when I was defending Target against Bill Ackman 10 years ago, when we called the index funds, we got Siri. No one was out there. There was no one to take the phone. Now, they are the most long-term of shareholders because what's happened is $1 trillion of AUM has moved from the actives to the passives. That's changed behavior. The active managers are in panic. They are supporting so many of these campaigns. It's rare when you don't see the active managers support companies. And if you have a hostile bid, defended a company called Medivation, made cancer drugs, great company 2 years ago, $10 billion company. They had a bid from Sanofi. Stocks at, just give me some, the stocks at 30, we sold it at 82. So the company wasn't entrenched. But at $50, the long-term investors that should have seen the research was at 65. The active investors who the company cultivated and learned, they had sold a good chunk of their positions. So all you had were the Arps and the index funds. So this, we hear, and all professionals go out and say, engage with the shareholders. It's clearly becoming more and more important, and that means engaging with the index funds. Because I had a panel we hosted at Evercore about a year ago in Techland, Silicon Valley. And we had the former CEO of eBay, who had defended against Icon, chairman of Microsoft. All 200 of these entrepreneurs wanted to know, how do we avoid going public? Or if we go public, how can we do it with dual class? Because Microsoft, Apple, Qualcomm, Juniper, every tech company on the West Coast had been hit by an activist campaign, except for Google, Facebook, and others. And so the market is speaking because these folks are less likely to want to go public. And I will tell you, it's a very disappointing thing to go into boardrooms, which I do so often, and they're concerned about, do we invest in a plant or do something because of its impact on returns. At some point, board members, this is where you have to step up and say, just take, do what's right, but not everyone is as courageous. People have come in to build a company, not have people dig through your garbage pails or call your third grade teacher and threaten you and things like that, because there are some activists who aren't as friendly, and it's a pretty brutal arena in that regard.
So can you talk about, to give a specific example, which was the almost year-long proxy fight for Procter Gamble last year, which won, I guess Nelson won by just a hair. So it was very, very close. I don't know whether or not, there was a lot of supposition in the press as to how BlackRock voted its shares, a very substantial stake. And can you comment on that, Matt?
So, sure, but before I do, we ought to put the size of the index holdings in a little bit of perspective. Basically, the index funds that we run, Vanguard also is a large index provider. State Street is the third. Those are the three big ones. There are others, but those are the three big ones. We control, on behalf of our clients, somewhere between 3% and in the high single digits, occasionally above that, but very, very, very rarely. You don't need, all your hands and toes to count them, although sometimes we do. And if you think about that, that's hardly a controlling position.
Well, I'd say, Matt, in most big companies, and I depend on many of the big companies, if you take the aggregate position of the index funds, it's close to 35%. And if you take out the people who don't vote, which are retail and others, so it's just, I'm not just BlackRock.
So you're right, that's true. But the index companies don't all vote in the same direction, and P&G is a good example of that.
Absolutely, agree with all that.
So we meet whenever there's a contest, either for corporate control of one form or another. This was a proxy fight seeking to elect one director. It was Nelson himself seeking to be put on the board. And in fact, he went on to say he didn't want to remove any director. He just wanted an additional seat so that if he beat someone in the proxy fight, the first thing he would do would suggest that that person be re-elected to the board, which in fact is what he did. So he would come and visit us. Nelson nowadays, and many, many activists, prepare big, thick white papers. Some call them white papers, some call them something else, but big, thick booklets describing what they want to do, why they want to do it, what they find at fault with the company that they're targeting. And the companies prepare rebuttals of similar dimension and nature. And so Nelson and his colleagues came to see us on multiple occasions, and P&G directors and the senior management came to see us on several occasions, and all presented their case, and then ultimately we had come the day we had to decide to vote. So apropos of what Bill just told you about not everybody votes, I believe it's right that we controlled at the time something north of 3% of Procter Gamble. It wasn't 4%. We actually wound up voting almost 5%. Because people did vote, other people. We voted, obviously. And it's not a secret, it's been in the papers, and Nelson has told the world that we voted for him. Vanguard voted against him and for P&G. And we don't unilaterally and monolithically vote. So we have an active group as well as passive group. And we have 100 portfolio managers. And if a security is in a portfolio of an active portfolio manager, and they have a view on how to vote, they're entitled to vote the shares in their portfolio. And at least one of our active managers voted for P&G. But to give you a sense of this, P&G, I believe, had, Bill, you'll correct me, 2.5 billion shares outstanding. And Nelson either won or lost, depending on who you follow, by about 50,000 votes. I mean, out of 2.5 billion votes cast, or 2 billion votes cast, or something of that order. So it was a very narrow and close to result, and it does. It's a good example of why people actually come and talk to us, because with 3%, that's still 120 million shares, and when you win by 50,000, 120 million shares matters. So I understand why people come and talk to us. But we never nominate a director. We're not an activist shareholder. Somebody's got to do something to get our attention. We don't stir the pot.
Evercore is in BlackRock's building. It's not coming to Evercore. It's like LaGuardia at Thanksgiving, people lining up to go see BlackRock.
Oh, now.
So, Bill, let's talk. I mean, in this situation, Procter Gamble, this was just about Nelson getting on the board, and whatever his agenda is has not fully been revealed at this point. I'm sure it will soon. But
You want his white paper?
I think most of it was in the paper.
I think so.
But certainly there has been a momentum building up in terms of activists in the M&A space, and not just reacting to announced M&A deals or trying to provoke M&A, but I would say firms like Elliott, who have both an activist division and a private equity division, are literally trying to create activity by either bidding or threatening to bid on companies. And the most recent example of this is Travelport. And I wondered if you could talk a little bit about that. In fact, at the Tulane conference last week, your former partner, Michael Carr at Goldman, was quoted as saying that that private equity and activism were twins separated at birth. Maybe you can comment on that as well.
This is being recorded, right?
Camera.
I'm just kidding. Look, the activists back in the day were raiders. I remember when I think it was Carl Icahn was going after Kerr McGee. It was like, I'm an activist now. I'm not a raider anymore. Raiders used to buy companies. Carl used to buy companies, buy stakes, and so maybe it's going back to that. And acquisitions, to push for a company for sale, that happens as a market for corporate control. Most companies don't have takeover defenses for the most part, so you put a bid out there. So I haven't seen that much of it. There's a lot of talk about the activists making bids. That doesn't happen very frequently. What you do see, and when companies talk about activists as short-term, I'm not sure that's quite right, not just because of the long-term board tenure of some of the activists. It's more a transactional focus. They come in looking to push a transaction. They're willing to take a number of years to do it, but they're transactional focused. And so they'll come in and a lot of them have talked to the PE players before they come in. They'll kind of know there's a bid out there. And so they come in and push a company. And a lot of companies, when they're facing this kind of push for a sale, they've got like a stack of paper of a response plan, but it really doesn't work. And what they're going to do, hit the activists over the head with it, is practically, do your shareholders want to do a deal at that price? Does that activist firm own 6%? Are they going to roll into the private equity bid? Do they have a different interest than other shareholders? It's a very complicated world. Your directors better be spending a lot of time and have the time to deal with this kind of situation. So I don't know if I'm not quite answering your question. It is something that companies face, not so much bids for the company, but they take a stake, push for a sale of the company, where there's some notion that there may be a bid out there. Companies, what do you say in response? You say, we have fiduciary duties, we'll look at everything, and the shareholder's like, what does that mean? Do you say there's no bid out there? Well, that kind of hurts your value. When there's no bid out there, you can't say there's no bid out there.
Right.
So it's a very complicated place for boards to be. The best thing that has worked is that if you have a couple of CEOs who've sold companies before, who are willing to spend the time to say to shareholders, we have the ball. If it makes sense, we'll do it.
Right.
Even if you got a sitting CEO who is a value creator and whatnot, shareholders still have some skepticism about whether they'll sell the company. So having a couple people with reputations on the line, that's about it. And so that's why those fights are harder to win for companies.
Right. And actually, that brings back the issue of how important it is to have a long-term strategic plan, which is the alternative you're offering your shareholders to some kind of abstract proposal for a sale. But going back to the issue you raised, Bill, on conflicts or conflicting issues, who's actually financing an activist bid to the extent it emerges?
Who's raising money for them?
Yeah, who's raising money for them? Is there a separate group of banks doing that? Because many of the banks don't want to be in the position of acting against, a long-term client in a context like that.
It's complicated. I think there's very few of them who actually advise activists, although that number is increasing.
But not so much advise, but finance.
Financing, yeah, there's different, and yeah, there's a lot of banks who make indirectly or directly, invest in them or do sidecars or whatnot. But these activists are pretty large fund-wise, even without the financing, and they don't use the financing that much. They're usually selling it to PE firms that have their own financing.
Yeah. Okay. Sarah, You've been monitoring activist activity for a long time, particularly at the council. Can you give us a sense for what kind of trends you're seeing emerging?
Well, I think one of the trends that both Matt and Bill have hit on with the facts they have offered is that if you are going to position your company as best you can for some kind of activist system situation down the road that you cannot identify now, you need to both be farther out in time ahead than most activist planning has been, and way more creative and multifaceted than has been the case before. We have a set of nesting boxes that show in the smallest box on the inside, this is the crisis, these are the things you do now. This is the next box of, you have an activist in the stock, so here are things that you do. This is the next box, we know we're in a sector and so forth. And then we have the bigger box, which I think is the most interesting one, and I also think it's one that most companies don't handle nearly as well as most activists do. That box has a lot of different things, like picking your shareholders. Bill mentioned how so many will sell out when there's an activist. There are a lot who won't. And when I was at Apache, we went and identified them and we courted them. And if they'd never held any stock, we said, what will it take? And we'll be back every year until you own the stock. Some of Apache's biggest shareholders are those. We went out to the environmental and social shareholders who care about the environment because they invest for the long term. And indeed, in one situation when Apache needed to make sure to get the vote, some of those environmental social shareholders called up unsolicited and said, we're going to call shareholders for you because you're a good company and we want your management team to stay. It doesn't get any better than that. Thinking about the hybrid funds that I think a lot of people will look at a Hermes in the UK and forget that it's in most companies' top 100 because it votes for 200 pension funds, but it probably shows up on a list as number 700. Talking to the quants, they vote. I keep saying no one runs for president by lobbying just the Presbyterians. Why would you run a company and basically have an IR division that's very good at talking to mainstream active managers? Lots of people vote. So there's picking who your shareholders are, knowing what language they speak. Most of the decks I see that are created by our world for the proxy voters are not in the right language. They're kind of an analyst deck made simple. If you're speaking to a German, you don't take French in a simple form. You speak in German. And companies are not yet good at saying what matters to these. So not just the big indexes, who I agree are always around, but there are actually a lot of shareholders out there that you can pick, that you can maintain. Second thing is you can focus on who is on your board in a different way. Already that happens a lot much closer when there's an activist in the stock. We've had a number of exchanges where we've said to clients, look, your number one goal right now is you need to win this next vote. You don't win this next vote, none of you are around to make any further decisions. So let's focus on that. And you're already looking for directors. So what about we speak to any of the half dozen people that the proxy voters in particular love, and who will, if they're on the board, give you at least a year, because they will believe that those people won't stay on the board if you don't.
That's just, I was going to say, that's we worked on a few of these together. Look, it's harder. Believing the
It's a
people,
hard sell.
the people who try to get on the equity capital market side to get people to invest. Believe me, if there's this, it's hard, but the work is worthwhile. The point you made, Sarah, is so important on board members. So how do these things play out? If you got a well-performing company and the person wants to push a breakup, what they do is they find two directors who maybe FIPS. Formally important people, and say we're going to go after them hard. They haven't been, they're going to target those two people, and then companies settle, and then the average tenure of a CEO of an activist in the stock is 15 months.
Right, exactly.
So you trade one portion for the other. So the looking at your board before the folks come up.
And think about whether you have directors not who have your industry experience. You have lots of time in other years to think about that. Who will get me more votes?
Yeah.
And who will at least get me 1 year? I got 1 year, I can think about everything else. There's a small subset of those people, because they're a tiny number that shareholders will wait a year for. It's a hard sell to companies. One of the things we say to try to push the thinking of how you pick your directors is if you look at the 2017 data, on directors placed by activists. 86% didn't go through the proxy process. 86%. So what the heck's your plan? You know, the plan is you can't wait and assume a proxy fight's too expensive.
Yeah.
And of course, there's this extra dynamic that if you're on a board and an activist says, look, you give me 2 seats, all the rest of you are safe, that's a very tempting proposition. And so you want to have thought about that situation before it happens. Certainly one advantage some companies could have is at least still most of the slates of directors from activists are all male. And 85% of proxy voters are females. What are they thinking? So there's certainly a lot of needing to push back on your planning and needing to think about different weapons because too many companies are fighting the last war.
Yeah, but it's interesting because we have some new people at Evercore who have a shareholder view. And that person who Matt knows very well told us 25% of these presentations companies are trying so hard, and maybe 5 years ago they weren't engaging. They're trying to engage, and they got to run a business. The activists can cultivate the shareholders all the time. It's the messages you deliver, and one of them has to be who your board is and why it's the right board to the shareholders. The second thing is harder, and we try to get the lawyers to give us a little more flexibility. It's hypothetically, if a breakup happened, here's why you have the right board to make the decision. Here's how you should think about it. Because if one of those activists is saying break up to the shareholders for 3 months, and then after you come out, because you're so afraid of Reg FD, that you don't make your case as to why the business makes it. This is a very complicated discussion. And sometimes the breakup should occur, by the way. But the point is to wait for the event to happen on you is what puts companies at a disadvantage. But a lot of times, the way it is to be a public company, you can't talk about whether you should sell or not. It's hard to talk about whether you break up. eBay is a great example. They were looking to find a CEO to come into that space when Icon came in. They were every year when I was at Goldman, we looked at whether they should break up or not. This company was totally willing to do that. But you can't talk about everything in the public arena.
But one of the things you can do that particularly works for directors, since they're not managers and they're not supposed to talk as managers, when they go on the road for engagement, we like to try to say to them, you're all about information in. You've got an IR department, a CEO, say their information out. And if you talk to shareholders and they decide that you are a leader and a statesman, they will tell you which activists they talk to. They will tell you what your reputation is. They will tell you, you can ask them a series of questions. The Apache directors always did this. If you could only own one company in our sector, what would it be? What really annoys you about us that has nothing to do with voting? What's the bit of our communications that mystifies you? How often do you want to see me? In fact, we tend to do the questions in a way that start easy and get harder because you have to have enough of a relationship that the conversation will. Plus, if one of the points of this exercise is to have the shareholders believe your directors are leaders, you don't do it by having them go in and read a deck of dumbed down IR information. You have them asking interesting questions. I've had on more than one occasion a shareholder say to me, when I have a director with me in the room, they turn to me and they say, are all your directors this good? And what I've realized is they assume that however talented directors are in their day job, they may not, in fact, know all that much about the company. So when you've got directors who hit it out of the park, there's some ways almost more of an upside because they expect management to know that. So if you think about it as information in, then the FD problem is not. Plus, if you take directors and not a manager, it's easier for the directors to say, I understand why you asked me that, but I can't answer it, but I'm happy to take it back to management. They do it once, you cut them off, they don't do it again. So I think you need to be farther out, more creative, use all the weapons for the new wars, not just the old ones.
Well, Regulation FD, that is the straitjacket, is obviously there to provide an even landscape,
right?
I.e. it's against selective disclosure.
Right.
So this challenge is to think about how to disclose it without doing it.
So which is why we've asked companies to publicly describe and discuss their strategy.
There you go.
And picking up on a couple of things that were just said, we would like companies to come see us on a clear day, not when they're under attack by an activist or otherwise an extremist for some other reason, but on a normal clear day, which means come see us in the fall, because in the US, because the proxy season typically is in the spring. We don't be offended if we decline your invitation to meet with us, but we will try to meet with as many as we can. And come see us, not necessarily every year, but every couple of years, because that will begin to develop a relationship. And as with all other things about relationships, that will stand you in good stead when there is an activist, because we'll know you, and we'll have a really much better sense of the company. Bring a director, preferably bring the lead director or the chairman, or chairwoman if there is a chair. Bring a director. In fact, we actually request that on a regular basis, and virtually every company now does. I say virtually because there are some notable exceptions, but virtually every company now does and is willing to talk. We care about directors, and why do we care about directors? We're not the management. We don't want to be the management. We're not capable of being the management because we don't know enough about the companies to actually tell them what to do. But we do want to hold directors accountable for knowing about their company, for understanding the ESG issues that affect their company, for being expert in the strategy that they have helped formulate or at least approved on behalf of the entire board. So we expect a very high level of attention and knowledge from directors. And the best way to demonstrate that is to bring a director or two along who can speak knowledgeably about the company. And most big companies, that's quite possible to do, frankly, because directors are pretty diligent.
Bill, let's get it. This is squarely in your area of expertise, and it's something you spend a lot of time with companies, and you actually get involved with clients in many cases much earlier than anybody else does. Talk about that issue, some of the things you can do to prepare, but let's talk about the director issue, because it may be that in certain very large mega cap companies, the boards are so sophisticated and they've come to accept this from their discussions with BlackRock and other major institutions. But Bill and I have been discussing that there's a lot of pushback on the idea of proffering a director on the part of management teams, and with good reason. Go ahead.
It's a fascinating dynamic to see the evolution of the corporate director and the relationship both with management and with shareholders. So you have this triangular dynamic. So you have directors, you have management, and you have shareholders, and there's a communication flow between each of the parties that has changed over time. And the thought of having directors speak to shareholders has made a lot of CEOs quite queasy over the years. But that is starting to change, and it's changing as each of my colleagues on the panel has been saying, because it needs to change, because there's a demand now for an articulation of the board's not only role, but real impact on the functioning of the company. And there's no more effective way to do that than to have a director speaking directly with shareholders. And let me take a step back too, because I think the election of directors is a very unique exercise in voting. You know, when shareholders vote on almost every other proposal, it's pretty clear what they're voting on. If they're voting up or down on an independent chair proposal or on executive compensation program, it's pretty clearly disclosed, and shareholders understand what they're voting on. With the election of directors, it's a perception vote. Shareholders don't really know which directors are contributing to the discussion, who's challenging management, who's really asking those questions, those insightful questions, and really pushing the CEO to see that the strategy is being well executed. And there was a time where the perception of the board was positive as long as the company was performing well. But that is no longer the case. The perception of the board is now shaped by various characteristics, some of them more generic, whether it's around gender and racial diversity, whether it's around skill sets. But now we're entering a phase where it's about engagement and and how do directors present themselves to BlackRock and other shareholders. And my last point would be, again, it highlights this dynamic that we have of sort of parallel paths when it comes to shareholder relationships. You have the traditional IR portfolio manager analyst path, but now you have this governance path that BlackRock, Vanguard, State Street, others fall into. That is a different type of communication, as Sarah said. It's a different language. They're asking different questions, and as a result, they want to hear from different people, like lead directors or independent chair. And mega cap companies are there. They're for the most part doing it, but I expect it to grow over time because, as we're saying, that's where the marketplace is taking this.
There are two other groups that we haven't mentioned that have a strong influence on things that get on the ballot or how the results turn out. One are the proxy advisory firms, ISS and Glass Lewis. There is a study done by an academic at Boston College which showed that on, I believe I'm correctly stating it, which showed that on the issue of say on pay, the proxy advisory firms, particularly ISS, but ISS and Glass Lewis, can determine up to 30 or 35% of the vote by what position they take in their recommendation. BlackRock does not follow ISS or Glass Lewis. We have our own set of guidelines. Some of them are coincident, some of them are not, and we obviously know what they do, but we really do it on our own. But that's a very big block, and even if it's exaggerated by a little bit, it's still a big block.
That's huge.
And the other is, in terms of say on pay, are the compensation consultants, who I know were on an earlier panel, and everybody now uses compensation consultants, and there is an inevitable appearance, if not a reality, of the ratchet effect of, well, you're being paid X here, so we're going to pay the same over here, and then it goes back and forth. I'm not arguing one way or another whether that's true, and the compensation consultants that we use would certainly tell you it's not true. But we'll see. But they are very influential, and the thing that always amazes me, and I'd love to hear your comments, is that say on pay can get 60% of the vote, 50% of the vote, sometimes lose. Yet the directors who are on the compensation committee get 90% of the vote. So people don't take it out on the compensation committee if they don't like the say on pay. That's not always true, by the way, at BlackRock.
Yeah, and typically in year one, that's the case. I think a lot of shareholders view say on pay as sort of a send a message vote. Okay. But if by year two the comp committee hasn't made meaningful changes, then you will start to see
directors.
Withhold votes.
Okay.
Withhold votes, yeah.
This director thing is funny. For mid-cap companies, large cap companies, there's a lot of engagement director-wise. Mid-cap companies, you're a CEO. You know the old Woody Allen thing, if you throw a football, two bad things can happen. You take a director out, the thought was, one, they violate Reg FD. Two is that they can't build the model, and the shareholders are like they don't know the business that well. Three is that the trading desks start calling up and saying, the directors are out there, the CEO must be in trouble. And the fourth is you build the relationship. Well, with the index funds, that's been a productive path. With some of the proxy voting groups of the active funds, it's been, but sometimes when companies try to say, because their directors are going to panels like this and then these CED things, and they come back and say, we have to engage. Couple things. One, it's not that easy to get some of these shareholders to meet with them. They reach out, it may take a long time, and they have to be patient.
2 words for that.
Yeah.
July and August.
No, even July and August, because
nobody does it in July and August. Because you mentioned the off season is the fall.
Yeah.
Proxy voters are so tired by the end of mid-June, and while they take vacation, the rest of July and August, I promise you, no one visits them. You can even take them out to lunch in July and August. Promise you it's true.
I'm not in the office that much in August,
Yeah.
but if I was, I can tell you that the BlackRock building seems to be pretty busy, even in August.
But it's important to mid-caps. You pick your best time frame, and that will help a mid-cap.
Yeah, and the second piece is that the director you pick, the camera ready, what have you, director. And
camera ready helps.
They have to be pretty facile on comp. They have to be pretty facile on the business, and it's becoming more sophisticated because guess what? If we have an M&A transaction, one of our key stops is to BlackRock, and the BlackRock team asks us, okay, CEO, give me 10 minutes with the director, help us understand this deal. That didn't happen 5 years ago, I'm sorry to say. I mean, it's just because, maybe because BlackRock wasn't as big, or because whatever reasons. Now, because it becomes such a big part of the shareholder base, and maybe directors are getting more engaged, that kind of conversation is tough, because I gotta tell you, I used to chair a lot of the Goldman Fairness committees, and it's hard to make valuation decisions. So having a director prep to make those discussions is a complicated thing. So the world's going to a different place.
I would add that having a director prepped to talk about a company's long-term strategic plan might be even more challenging.
Mm-hmm.
And it really requires the right board member and the right trust between a CEO and the board member. And, you know, there are real pros and cons of, I believe, on the view of management, and deservedly so, to just, you know, unleashing directors on your major shareholders. So I think this is an area that is still, you know, notwithstanding BlackRock's and some other major institutions' position, it is an area that is still being, you know, emerging and being sort of managed by, you know, on an ad hoc basis by various management teams.
I think that's right, but if you view it as unleashing directors, that answers the question. If you view it as having directors demonstrate their expertise in the company.
There you go.
And I think too, again, if it's just directors, it's easier than I think most companies fear for directors to say, we talk about this in the boardroom, but there's very little that I can share with you, to talk about the board's view of how strategy is set, and then to send the other questions to management. I do not think directors are diminished by that. And so often we look at prep, and I'm saying, you're prepping a manager. We're not prepping a manager, we're prepping a director. And I think it's easy for a director to say, you know what, I can give you a couple comments on that, not many, but tell me how you think about it first. Tell me where the missing pieces are, because I'd like to get a sense of how you're seeing what we're doing. So you do the information in, and then you can say, here's what I can say. It's really easy to say, here's what I can say. I think you just stop. So I think it's getting easier. And I think directors, if they think they have to know the strategy in as much detail as, that's when they take a deck. And directors should not read decks ever.
Nor should management. Nobody should read decks.
Yeah.
Right, nobody should read decks.
I would just add to that, you know, if there is angst about putting a director out there, then that should tell management something. And I think it goes to the thought process behind who holds certain leadership positions within the board. So who is the lead director or chair?
Very much so.
Who chairs one of the key committees? I fully acknowledge, you know, this is not a one-size-fits-all. It's not for every company in every circumstance. But there's no question of the trends, and there's no question of what is being expected of corporate directors today. And I think it goes very much to the initial topic we were talking about around activist events. And as Matt said, you know, if you wait until it's upon you to decide to reach out and to introduce your lead director to us, well, you're by definition in a reactive state, and you've lost a certain amount of credibility by handling it that way. So this is, I think, a strategic decision very much intertwined with how the company executes its long-term vision.
Well put. I think that's a perfect note to stop on. I guess we could, if we have just a few minutes. Go ahead.
Yes, questions?
Yes.
They're coming with a mic.
She's coming with a mic
behind
for
you.
you,
Oh, thank you for a very interesting panel. My name is Deirdre Lepin. I'm a former Sustainable Development Manager for Shell. And I have a question about what is the best way to make a judgment about ESG. There are so many standards out there now. There's the Equator Principles, there are the IFC performance standards, there are the voluntary principles, etc. How do you make a standard for the standards and make a judgment?
You're right, there are 650 different ESG scorecards, and there are standard setters for standard setters, and there are certifiers of standard setters for standard setters. And of course, much of the ES information that gets graded is not actually being disclosed by companies, which makes it a lot harder, certainly for companies much smaller than Shell. What we say is, don't take a test without looking at the test questions. Your biggest exposure is going to be your MSCI and your Sustainalytics score. They tell you what they grade on. So for crying out loud, go look at the list of things they grade on and then disclose the way they talk. You may be doing something just right, but you called it a practice. You didn't call it a policy. And you only get credit if you call it a policy. Well, you should go read that. So quite apart from the 650 different standards, think about which are the ones that get in front of most of your shareholders. Now, obviously being UK, Dutch company, you have to think about Vigeo Eiris, and I would have said Occam, but ISS is buying them. So the two main European players, but that's the easy starter. You have the separate question of essentially, what are you benchmarking your reporting to? Is it the SDGs? Is it the GRIs? And of course, those change in fashion, like women's clothing. Every couple of years, and SDGs are cool and GRI is less cool than it used to be. That's just an indexing for how people find things in your report. I think the starting place, given that you have to operate where there's 650 variables, is look at the things that your main shareholders buy. It's those two. So obviously, ISS now has an ES scorecard, and they disclose their 300 variables, and you can look. And you can actually go in and submit information where you think they've gotten it wrong, and they're very responsive to that. So you should not miss the ISS ES card. And second piece, quite apart from that grading, is another reason for the kind of director engagement is your big shareholders will tell you the things that will keep them loyal. And sometimes you can change their minds. I mean, you can absolutely say, I know you think options are a purely time-based vehicle. That's the silliest thing I've ever heard. No passage of time will make a stock option worth anything unless your stock price goes up. So you have that second kind of fallback for the ones. I think companies make the mistake of focusing on their largest shareholders, and yet it's often smaller shareholders who I say kind of start the trouble. It's only the big ones who vote on it. Well, if no one's starting trouble, there's nothing to vote on. Plus, there's some shareholders who are networked to way more than others. And if you ask a few of those, okay, I know you just pulled the data out of MSCI. Which are the 3 points that you pull? Which will affect your independent scoring of us? But I mean, Shell obviously is way more sophisticated. You have a scenario plan going out to 2070? Oh my goodness. But for regular sized companies, great, disclose to the test. And then, by the way, go visit them when they grade you incorrectly, and they'll often fix your grade.
So in the area of ESG, I commend to all of you to go to your iPad or your computer and go to our website. We have 15 different papers that they're very short. They're a couple of pages at most that explain how we view. And it's not necessarily the only way to view it, and it's not necessarily the best way to view it. We don't pretend that it is, but it is the way we typically tend to view not just the climate change, which is for an oil company the hot button I know, but also how we deal with human capital management, how we deal with a range of issues, and it's there, and you can look at, and we're happy to discuss any of those with companies and try to come to an understanding of how you view it, and if there are differences, why. And you might persuade us to change our minds. We're not immutable or set in stone.
There's a question in the back.
Go ahead.
Press count of trustee chairman HRI Properties. One of the storylines about corporate raiders, takeovers, is that it has exacerbated income inequality and caused companies not to spend money on research and development or wages, and is a very bad thing. Is that accurate, or is it overstated? Is it hyperbole? Is there something to that?
Bill, you want to take a shot at that?
Well, I'll give you an anecdote, the one I started with about that tech conference on the West Coast, where so many of the tech companies wanted to stay private so they can invest in their business because they felt the capital markets weren't their friends. I don't agree with that, but it's certainly a sentiment. But look, every one of these activist campaigns are a bit about, hey, you can get your margins up quite a bit, which is about a euphemism for, cutting R&D and cutting costs and cutting people. So, look, some companies need to be more efficient. There's just it's hard to be too doctrinaire on that, but most campaigns have an element of cutting R&D, cutting spend, things like that. And that's why I think it gets the short-term mantra, not because they're in and out, because if an activist fund says boo, pushes the company and leaves within 3 months, they won't get the investors to support them in the next campaign. So there was a fund called Pirate Capital. Every Friday they used to send us a fax like, do this, do that. They had skull and crossbones and they came in and out. In those days, 10 years ago, there was some of that that's really not there. But yeah, there's an element of pushing pretty hard on those things. Some companies may need it. Some of them, because of how many activist campaigns there are, I'm pretty sure that most companies don't need that.
Well, thank you. I want to thank the panel. This has been a terrific discussion.